Okay, welcome back. And joining us at this hour is also Sudeep Bandyopadhyay. Of course, Kunal still with us. Sudeep is market expert, as everyone well knows. Kunal, let me come to you though first. And, we spoke with PB Fintech earlier today. The stock is down 6% on the back of good numbers. Still, the stock is down. Likely because of two reasons. One, there is a fear in the market. And Sudeep, I'll come to you on the fundamental side. One, there's a fear in the market that take rates might come down for PB Fintech. So that is one. Take rates is nothing but the commission rates that they earn. And second is the fact that they're going to invest 5,000 crore plus, which is they're going to do a QIP as well, to invest in international markets. Now, this could well be a positive lever, but markets obviously not perceiving it so, because we're still just about turning profitable where PB Fintech is concerned. That's my reading of it. I'll come to Sudeep. Kunal, with regard to your view on charts, how is this one looking?
See, many a times you have to try and judge the view on the stock with respect to the overall market. So there is like a 30% to 40% weightage, which we generally give in the overall market scenario. A few days back, maybe last week or so, when we were discussing about PB Fintech, the charts were really disappointing because the stock was going into the results as well as into the budget on a much more negative note. Now today, after this 5-6% kind of a gap down or a downtick move for PB Fintech, the volumes being on an extremely high side, it looks like that the stock is now nearing a major bottom for itself. I would believe 1400, 1450 should be a good zone where traders could look to start accumulating PB Fintech, and it's a good time to try and go contra, because after this kind of 7 out of the last 10 weeks negative price performance and the stock correcting from 1900 levels to now 1450, 1470 plus kind of a mark, I think it's going to be a very good price territory as well as a risk reward to initiate a buy on PB Fintech.
Sudeep, what's your view?
Well, the market is definitely worried. Whenever a company talks about investing big amount in the global markets, I think market takes it with a pinch of salt, and that's exactly what is happening. Deploying 5,000 crore plus in the global market, I think is a completely uncharted and unseen territory, which it's definitely a matter of concern from an investor's point of view, and that's the reason why it's coming down. The take rate coming down and other things are well known, and that's pretty much manageable with the volume increasing on a continuous basis and scope for volume to go up from here on also significant. I don't think that's a matter of concern. What is a matter of concern to the market is the plan to invest in global markets. I think that's definitely a matter of concern, and I'm not sure why the company is doing it, because as you rightly said, they've just turned profitable. There is significant underpenetration of insurance in India, and the Indian market is, needs to be captured in a much better manner before there is a need to really look for markets outside of India. I was hearing, the views of the management that they need to be in global markets just like global companies are in India. All that is fine, but is the timing right? Are we ready for that? Do we need to deploy that kind of cash outside India? I think those are the questions which the investors are grappling with.
Yeah, absolutely. And yes, so that's the view coming in from Sudeep, of course, with regard to what he believes from a PB Fintech perspective. But Sudeep, if I can just extend that question maybe a little bit more. Is this, so market is clearly concerned, and which is why the stock is down 6%. Now, this is a 65,000 crore odd market cap company now. Looking at a profit after tax number of around 1,000 crore by FY27, which leaves it at around 65 times. And it's not growing at a very slow pace either. So, and they've said acquisitions will be EPS accretive for them. So it's not like the acquisitions that they're going to make are not going to be EPS accretive. So you're looking at a base level price to earnings ratio of 65 times, fast growth business. Would you believe that it's a good time to enter? I understand your view that you're not sure as to why they're diversifying, but EPS accretive transaction, if they are assuring, would it be something that interests you?
Well, Harsh, look, Reliance sometime back, if you recollect, I think in the AGM, last AGM, had talked about Reliance Jio getting into Africa. And the share was beaten down. Investors were nervous about Reliance, which is a behemoth with piles of cash at their disposal, and their entry into Africa to compete probably with the local players as well as Airtel was looked down upon by the market as a big negative. So from a PB Fintech point of view, naturally this will look upon as a negative development, and the market will not like it. It's obvious. But having said that, to your specific point about acquisition being EPS accretive and things like that, that's absolutely uncertain today. We don't know what is the acquisition target. I'm not very sure whether the company is also aware of any specific target and the transaction. So it's a little premature to talk about that. Yeah, as a policy, if they talk about acquisition only being EPS accretive, I will probably still live with that. But again, I will say that there is enough and more opportunities in India at this stage as far as insurance distribution is concerned. There are stages of development which the company needs to go through before venturing into global markets. And I would say that the multiple is not it's not a very cheap multiple. It's at a significantly elevated multiple at which the stock is quoting. So the margin of error is very, very limited. So I will be extremely cautious with this planned international foray.
Excellent. Sudeep, made for a very good discussion. So thank you for that. Sudeep, I'll come straight back to you in a bit, but let's bring on board Rahul Chadda as well, founder and CIO at Shikhara Investment Management. Rahul, it's been a while, so great chatting with you. Let me get a sense of how you're looking at the market moves today, and what are the opportunities that you're looking at nitpicking, or have you already nitpicked it a couple of days ago during that bit of correction that we saw on budget day?
Yeah. No, clearly, again, look, Indian markets were in a buy zone. What we were seeing was a classic retail peak. Over the last 2-3 years, we had huge amount of retail money which had come in the market. People had not made much money for the last 12, 18 months, and which is where this capitulation was happening. The sentiment, I was in India recently, and the sentiment was extremely downbeat with investors, with corporates, etc. So I think that's where this framework for US-India trade deal removes that big overhang. From a FI perspective, what was worrisome was rupee. Look, we all know that rupee depreciation was kind of an affected to give some export to the exporters. But as an outsider, when you see most currencies appreciating 5 to 7% against dollar and rupee depreciating 5 to 7%, I think that was something which was keeping the foreigners at bay. So now with that kind of an overhang behind us, I think foreign investors would look more constructively at India. What we are expecting is in the coming quarters growth to pick up. We've already seen from a regional perspective, look, it's basically Korea which is doing well. Growth is still tepid in China. So I think as some of these overhangs get mitigated and earnings kind of an improve, you should see more FI inflows in the country.
Okay. Sudeep, one quick question. So we've seen markets now quite buoyant. What do you buy at this point? There's certainty now, both on budget as well as on India-US and India-EU as well. What are the opportunities you're looking for? What are you hunting for at this point, Sudeep?
Well, I think, if you had to look at trade deal dependent stocks, I think that boat has sailed already. And things have really hot as far as those export oriented sectors. So I definitely don't want to buy those stocks today or tomorrow maybe. Let things settle down a bit. Only then we should look at those stocks. I will probably stick to my old favorites like frontline large cap stocks like a Larsen to Grow, like a Bharat Forge, because they have a developing defense business inside them, and the budget did give a lot of allocation to defense once again on the expected lines. I will definitely look at chemicals and agrochemicals and specialty chemical space, because I think beyond the fact that they were beaten down mercilessly over the last 2 years and the performance was horrible, I think things have started improving generally, and the trade deals, getting done definitely helps these companies. The China plus one logic continues to remain valid. So from a long-term perspective, I think agrochemicals, chemicals, specialty chemicals, these definitely should be looked at. And some of the leaders in this space, whether it's UPL, whether it's Aarti Industries, whether it's SRF, can definitely be looked at from a long-term hold point of view.
Okay, Sudeep, thank you so much for joining us. We'll let you go on that note. Uh, and that's, of course, Sudeep Bandyopadhyay with regard to his views. Uh, Kunal, let me come back to you. Realty, it's done ever so well. It's held up very, very well for itself. Is this a sector which continues to look interesting? I know your top pick is DLF within that realty pack. But talk to us about what levels one should anticipate going forward in the short term and in the medium term, where some of these names are concerned.
See, I would believe now that realty as an index would look fairly attractive on two fronts. One, of course, on the price front, because for the calendar year 2025, realty, if I'm not wrong, was one of the worst two underperforming sectors as such. Then you start of 2026, the realty index actually fell by I think more than 10 or 12% from its immediate highs. So I think that was also one of the key points. What this brought into was a point where many of the real estate names, large cap names like DLF, Godrej Properties, the mid cap end of the real estate stocks, these stocks are now at a divergence of almost 10% to broadly even 20%. Some of them were from their long-term moving averages. That throws in a good opportunity to try and go for a good risk-reward trade. The other and the most interesting part is when markets try and come back, when the news flow starts to become a lot more better. So, we say that the ground is for the market is a lot more better and not shaky as maybe in the last, few weeks, few months. That probably, props up the sentiment from a trader perspective. And that sentiment, increasing up higher generally calls in for a better risk appetite. And in those time frames, the high beta sectors, they tend to do very well. So broadly, would expect the realty index to continue to move up higher. DLF from current levels, I would look at 675, 680 as a target. Godrej Properties, after this 8% kind of a move, I would expect potentially another 7 to 8% climb up over the very short term.
Wow. So very, very bullish with regard to Godrej Prop. Nearly 9.5% move as we speak on Godrej Properties. Rahul, let me come to you. Is realty something which is looking good, good value, low hanging at this point, and where risk reward is really favorable in your opinion from a funda perspective?
Yeah. See, we had a lot of realty names coming out of COVID and made a lot of money in that. But over the last 12 months, we've been booking some gains there. I think this whole impact of AI disruption, not enough white collar jobs being created, would be felt on reality. And look, this is a sector which has done well, well known. Affordability is not bad, but not as compelling as it was 4 or 5 years back. So I think we would look at sectors other than reality. Reality, there would be kind of a technical bounce here, but outside that, we'll be more focused on some of these manufacturing export stories. Now that this overhang with India US is behind us, we've got an India EU kind of a trade deal also. Some of these manufacturing companies in auto and etc., which are supplying to these regions should be positive. And then some of the good consumption names, Eternal, etc., discretionary consumption, they've corrected fair bit. I think these names offer a favorable risk reward for medium term investors.
Okay, what we'll do, Rahul is slipping to a very short break. We'll continue conversation with you on the other side. I'd love to chat more with regard to sectors and pockets that you're liking. Stay with us, viewers. Right, welcome back. And some big movers in trade today. Both the Adani twins, in fact, are the big movers. 9% higher on Adani Ports. They've said that their top line will come at the higher end of the guided band that they've given. And Adani Enterprises also up 11% in trade. So those are the two names that are really shining. No losers on the Nifty 50 index, or just about fluctuating. Maybe Tech Mahindra absolutely flat, maybe slight negative bars, but outside of that, no losers on the Nifty 50. It's a very, very solid day of trade. Rahul, let me come back to you. You know, one stat that's gotten buried on the back of the budget plus the India-US deal is the fact that credit growth was extremely strong in the month of January. In fact, we saw 4% MOM growth. Sorry, apologies, in the month of December. This is basis RBI data that came out. There was 4% month-on-month growth in credit in the month of December. So we've seen very strong tailwind. How would you play that? So within financials, how are you playing this?
So again, for this improvement in the recovery or the credit growth, one would look at that through banks, private banks, some select NBFCs, some of the mid-cap banks like AU banks, etc. Is through how we're playing this. And then what the credit growth kind of signifies is pick up in the economy. So you've got equally strong leverage, which comes through some of the select consumer discretionary plays I was talking about. Some of the industrials, I think we're a strong believer of a new industrial cycle. The last time we saw this cycle was 2007, and it's nearly 20 years of underinvestment in the world. So you look at the huge demand which is coming for investing in the power infrastructure, investing in the defense sector in Europe, that's huge. And I think that's where opportunity opens up for some of these Indian companies who are exporting there. Plus, locally also, with this trade deals happening, our sense is private sector confidence should come back. See, there was clearly a lack of confidence. People were just holding back, basically. With some of these uncertainties out of the way, and government encouraging local investments, etc., you should see pickup. So industrials is a sector one would closely watch here.
Uh, and Rahul, if I can switch back to the trade deal itself, uh, of course, a big positive. There's no doubt about that. But could there be negatives? Like, for example, if there was a 0% tariff on goods imported into India from the US, could it be substantially negative for, say, auto companies?
Absolutely. See, I think auto stocks in India are clearly expensive. And why we say that is across the region, you've got the likes of BYD, again, other Chinese companies like Hyundai Motors, the parent, who are trading at 5 to 10 times earnings, basically. And they have core skill sets which are much better than some of these Indian companies. So if the duties get reduced, look, auto sector is something which would be negatively impacted, which is why we've not engaged or we're not invested in many auto companies here. But look, there are going to be winners and losers. But overall, again, these trade deals are healthy for the economy, and I think that's what we should focus on.
Okay. And, you know, OMCs as a pack has done very well again. And Rahul, they've done well, yes, but there's also the analyst community, at least a certain cohort, which sees potential upside even from here. Does that, or I don't know how you view it, but would that thesis, if you view it that way, would that thesis change materially given the way in which the trade deal is likely structured? Of course, the fine print is still awaited.
Look, OMCs were defensive play because there was not much happening in the economy. People were not in the domestic cyclicals, or people were not looking at the growth names, which is where money was hiding in these cheap value OMC names. Um, Growth's been always an issue in these names. These are more of a trading place. You buy them below book, kind of, and play them for a little premium to the book and then move to something else. We would look at more structural stories. Now that those big overhangs for the growth are behind us, over last 12 months, you've seen a lot of action by the government to kickstart the growth. See, unlike 2024, where it seemed like the administration, the Indian administration was more complacent about growth, were focused on other things. 25 is where you've seen all the eyes on kickstarting the growth, on getting the business consumer confidence back. So as the growth comes back, money is going to move out of these defensive sectors like OMCs, etc., and go to growth sensitive sectors. And globally, our view also is that we are not too bearish on the world. You had consumers, businesses holding back last year because of all that trade uncertainty which was going on. As that uncertainty recedes, business should kind of invest more, economy should improve from here. So we would be constructive in our portfolios here.
Excellent. Rahul, this has been a very good conversation. I know that we've broken this conversation up into a few parts, but we've gone through with it nonetheless. So thank you so much for joining us this afternoon.
Thank you.